Welcome back, Navigators. In this video, we'll learn how the index operates, its historical performance, and how it can help investors make strategic choices about asset allocation, portfolio diversification, and investment strategies. Ever wondered what the S&P 500 really is and why so many investors swear by it? Imagine this for a second. A bustling arena full of 500 heavyweights, each vying for the top spot. That's the S&P 500 for you. But instead of athletes, it's the titans of the US corporate world we're talking about. The S&P 500, or Standard & Poor's 500, is a stock market index that represents the performance of 500 large companies listed on US stock exchanges. Think of it as a barometer for the US economy, reflecting the health and trends of the market. It's not just a list, it's a dynamic, ever-changing entity that's at the heart of global finance. From tech giants to healthcare leaders, consumer goods to financial services, these 500 companies are the ones shaping our world. Now that you understand what the S&P 500 is, let's delve deeper into why it's so important for investors. Remember the dot-com bubble of the late 90s? How did the S&P 500 react to this seismic shift in the market? A tech boom like no other, the late 90s saw the birth of internet-based companies, or dot-coms, multiplying at an alarming pace. This era was characterized by boundless optimism and sky-high valuations for these fledgling firms. The S&P 500, with its heavy weighting of tech stocks, soared to unprecedented heights. But as we all know, what goes up must come down. The bubble burst in the early 2000s, wiping out trillions in market value. Yet the S&P 500, despite taking a significant hit, proved to be more resilient than many individual high-flying tech stocks. How so? The answer lies in diversification. The S&P 500 represents a broad swathe of the market encompassing various sectors, not just technology. So while the tech stocks plummeted, other sectors within the S&P 500 remained firm or even gained value. This ability to weather the storm is a testament to the SP's strength. It underscores the importance of diversification, a key strategy for any investor seeking to mitigate risk and maintain steady growth over time. Fast forward to today, the S&P 500 not only recovered from the dot-com crash, it grew exponentially, reaching new all-time highs. Despite the drastic tech bust, wars, crisis, pandemics, and the like, the S&P 500 demonstrated resilience, offering a valuable lesson on the importance of diversification in your investment portfolio. Ever heard of the phrase, "Time in the market is better than timing the market"? Well, it's not just a catchy saying, it's a fundamental principle that many successful investors live by. Let's consider for a moment the magic of long-term investing, particularly in the context of the S&P 500. The S&P 500, a collection of 500 of the largest companies in the US, has historically been a reliable powerhouse for returns over extended periods. For instance, consider the case of those who invested in the S&P 500 in the early 1980s. Despite multiple recessions and market downturns, their investments would have grown exponentially, providing a solid return. More recently, the historical average yearly return over the last 10 years ending the 30th of April 2024 is 12.58%, with dividends reinvested. Adjusted for inflation over the same period, the return is 9.52%. And from its launch in the current format back in 1957 up to the end of 2023, the average annual return is 10.26%. Quite impressive, don't you think so? This growth is not due to luck or chance, but the power of compounded returns. The snowball effect, where your earnings generate even more earnings. This is where patience pays off. Sticking with your investments through the highs and lows can lead to substantial growth over time. Take the story of Grace Groner. She purchased 3 shares of Abbott Laboratories for $60 in 1935. By the time of her death in 2010, her investment was worth $7 million. That's the power of long-term investing and compounding. So, while the market's ups and downs can be nerve-wracking, remember that patience and time can be your greatest allies. As we've seen, investing in the S&P 500 for the long term has historically been a winning strategy for many investors. Even Warren Buffett recommends investors staying the course with the index for the long run. So what have we learned about the S&P 500, and how can you use this knowledge to your advantage? We've understood the structure of this influential index, a valid benchmark for most investors and portfolio managers worldwide, bearing witness to its 500 diverse constituents, all contributing to a snapshot of the US economy. We've journeyed through its historical performance, observing its resilience during market downturns. We also underscored the power of long-term investing by adhering to this simple but effective tool. So how do you leverage this knowledge? It's simple. Consider the S&P 500's diversity when diversifying your portfolio. Remember its resilience in tumultuous times and embrace the power of long-term investing. With these insights into the S&P 500, you're better equipped to navigate the world of investing. Add it to your arsenal in building a strong portfolio using low-cost ETFs such as SPDR S&P 500 ETF SPY, iShares Core S&P 500 ETF, IVV, or Vanguard S&P 500 ETF VUO. These should be available with almost every broker in the world. That's all for today. Until next time, take good care of your finances, navigators, and don't forget to subscribe and share if you found any value.